Joining me now is Dan Rohinton, Portfolio Manager at IA Global Asset Management, here to talk markets and some specific stocks as well. Dan, thanks for coming in.
Thanks for having me.
What do you make of these markets right now, and how should investors, how should your clients be thinking about this quick start that North American stock indices are off to so far this year?
It's been, generally speaking, a reasonably strong start to start the year. That tends to happen more often than not. It's known as the January effect. But I think it's also important to zoom out a little bit further, Paul. If you look at what's happening in Europe and also in China, those markets have been far stronger as well. So there's been a torrid rally in the European markets, and there's been a torrid rally in the Chinese markets as well. So it is really a global rally that's been moving higher, but this tends to happen in January before we start finding our footing on where the real trend is going to be later in the year.
Is this a so-called climbing a wall of worry situation? There seem to be lots of reasons to be anxious about the near-term economic outlook.
I'd classify it a little bit as a mean reversion rally, where the areas that have been beaten up a little bit more, and inclusive of Canada, which had lagged historically for 4 or 5 years before, it's been catching up more so. So think of it more as a mean reversion type of rally to start the year than necessarily a true high correlation trend going on.
Okay, what sectors of the stock market do you favor right now?
I think it'll be interesting just to talk a little bit about the more defensive sectors of the market. So one area like Canadian midstream has been left actually a little bit in the dust with some of the noise around tariffs. It's important to understand these are contracted cash flows, gated ROE hurdles. So the cash flow stability is truly there. That's what pipelines are supposed to do. So there's some companies we can talk about there. And also, if you zoom out a little bit into the U.S. market as well, the utility sector, I think, is getting more interesting, especially since U.S. rates are no longer rallying like they were before.
What sectors are you avoiding or underweighting?
We're incrementally selling a little bit more on the technology side. It's not that we're 10 years negative on technology, but it's important to appreciate that it's a bit more of a complicated question where the monetization has to come through for all the software companies. The hardware spending has to really come through in terms of the returns on equity that are spent on all that CapEx. So it's trying to find a balance where we're getting a bit more defensive and we're peeling away a bit from technology and going more into defensive utilities.
Okay, let's talk about some individual stocks. I'd love to get your view on Air Canada, which has really lost a lot of ground since the middle portion of December or so. What's going on at Air Canada? You don't. My understanding is you do not own this stock on behalf of clients.
We don't own the stock. Generally speaking, I'll zoom out before I go into Air Canada. Airlines as a whole have been getting a bit of actually, it's been a strong bull market in North America for airlines. Air Canada is a bit of an exception to that conversation because the Investor Day, they made a commitment to actually add more capacity, which in generally speaking, quite a narrow Canadian market, does mean that you're in a position where RASM is going to come down. So that's basically revenue per average seat mile. So it's just talking about more margin compression as we look ahead. So the stock had seen a big acceleration into Investor Day, and now we're giving most of it back.
Okay.
So conditions are broadly benign across the industry, but Air Canada is on a slightly different setting.
Do you ever invest in airlines on behalf of clients, or do you avoid the group? There are some portfolio managers that avoid the group.
We strongly desire to stay away from them, but we also make sure we do our research to make sure we're not missing anything structural that's changing. Okay. So the U.S. airlines are getting more consolidated. They're more profitable than ever before, but I like to own earlier stage in the value chain than airlines.
We get a lot of calls on this channel on Shopify, the Ottawa-based tech and online retailing giant. What are your thoughts on Shopify and its current valuation?
I mean, 15 times sales tells you a lot of what you already need to know. So it trades at basically about the highs that it has been in its recent history. That's for good reason. The execution has been very strong. Their GMV growth in the mid 25-26% range, if I recall correctly, and the margins have been coming through. So they're on trend when it comes to social commerce. They're on trend in terms of micro merchants. The jury's a bit out on the tariffs around the de minimis packaging rule, which is where a lot of drop shippers from China drop ship directly into the U.S. market, and that is through those are Shopify merchants. So there is something to be said about some areas of the business being a little bit weaker, but the business is firing on all cylinders. I would just say at 15 times sales and 90 times earnings, it's probably not a bad time to take some profits.
Okay, you talked about utilities and energy midstream as a sector you like. Enbridge is a stock that you like, and I believe you do own. You own this one for clients.
Yes, in significant size, and the reasons for it are quite simple. The cash flows are contracted out. And think of Enbridge as part utility and part midstream. midstream, realistically, unless there's a complete green light from the government and certainty around the cash flow profile, they're not going to invest behind that. And what you really have is rate-based growth, so utility-like growth with the midstream multiple to it. So you get mid-single-digit adjusted AFFO, as it's known, adjusted funds from operations, and you get a 7% dividend yield along with it in one of the most diversified companies in North America in the space.
Do you have any quick thoughts on the tumble that the stock took on Friday? It was down 5.5%.
You know what? It's ironically, they don't have enough data center exposure. So people are looking and saying, where's the sexier utility? And that's really where the attention has been gravitating towards. So I think, and I purposely brought up Enbridge because I think the dip is a buying opportunity.
Okay. In the U.S., in a similar sector, this is a gas and electricity utility. CMS Energy is one of your picks and one of your holdings.
Yep. Once again, in significant size for more of the global portfolios. And the reason behind CMS is it's simple. It's a great state to be a utility. They have a great relationship with regulators. You're allowed high returns on equity, and you're allowed to grow in a consistent, stable manner. So this is a company that will pay you a 4% dividend yield, and you can get 8% earnings per share growth for the next 5 years. And that's contracted out, proven out. And if you look back at their history, they've grown 7% per year for the last 8 years. And this isn't an average, smoothed out figure. 7% per year is the algorithm. So where else can you get basically double-digit total return with that level of stability? And it's because rates have been elevated in the way that they have been more recently that these types of utility and cash flow, strong cash flow businesses tend to get undervalued when HISAs are available at 3-4% rates.
Dan, thanks a lot for joining us today.
Thank you, Paul.
Dan Rohinton is a portfolio manager at IA